What if I told you that building wealth doesn't begin with picking the perfect stock or predicting the next market crash? It begins with making one simple decision: to start. The problem is that investing seems complicated. People hear words like ETFs, index funds, dividends, brokerage accounts, market crashes, and compound interest, many of which we've broken down in simple terms in our other videos, and decide they'll learn about it later. But later often becomes years. And while they're waiting, time keeps moving. The truth is, getting started is much simpler than most people think. Today, I'll show you a straightforward roadmap that millions of long-term investors follow. No hype, no promises of getting rich overnight, just a practical way to begin. The first step isn't actually investing. It's making sure your finances are stable enough to invest. That means paying off high-interest debt, building an emergency fund, and making sure you won't need to sell your investments because of an unexpected expense. Once you've reached that point, the next step is opening a brokerage account. Think of it like opening a bank account, except instead of holding cash, it allows you to buy investments. There are many different brokers available depending on where you live. Most only take a few minutes to set up online. Now comes the question everyone asks: what should I buy? Many beginners think they need to find the next Apple, or the next Tesla, or the next company that's going to explode in value. But history has shown that consistently picking winning companies is incredibly difficult. Even professional fund managers often struggle to beat the market over long periods. That's why millions of investors simply buy the market instead. An index fund owns small pieces of hundreds, sometimes thousands, of different companies. Instead of trying to guess which business will win, you own them all. As economies grow, businesses grow. And over long periods, investors have historically benefited from that growth. The next mistake many beginners make is waiting for the perfect time. They think they'll invest once the market falls, or after the next election, or once the economy looks better. But nobody knows exactly what markets will do next. That's why many investors use a strategy called dollar-cost averaging. Instead of trying to predict prices, they simply invest a set amount regularly. Every week, every fortnight, or every month. Now here's where things start becoming interesting. At first, your investments won't seem to do much. The first few $1,000s often feel slow. But that's completely normal. Because investing isn't about making money quickly. It's about allowing time to work in your favor. The longer your money stays invested, the more opportunity it has to grow. And eventually, that growth starts generating more growth. That's compound interest. As your investments grow, some companies may also pay dividends. These are payments made to shareholders. Many investors choose to automatically reinvest those dividends, buying even more investments, which means future dividends are calculated on a larger investment. Over many years, that cycle can become incredibly powerful. One thing that's guaranteed to happen is that markets will fall. Sometimes by a little, sometimes by a lot. Every investor experiences market downturns. The difference between successful investors and unsuccessful investors usually isn't intelligence, it's behavior. Successful investors understand that market declines have happened many times throughout history. And despite those setbacks, markets have historically recovered and continued reaching new highs over long periods. The biggest mistake isn't seeing your investments fall. It's panicking and selling because they did. Building wealth doesn't require predicting the future. It doesn't require checking stock prices every day. And it certainly doesn't require becoming a financial expert overnight. It requires consistency. Invest regularly, stay patient, ignore the noise, and let time do most of the heavy lifting. Building wealth is usually simple, but simple doesn't mean easy. It takes patience, discipline, and the willingness to keep going when progress feels slow. Because years from now, your future self won't care whether you started with $100 or $1,000. They'll simply be grateful that you started.